Okay.
Hello.
Yeah, Mr. Nat.
Yeah.
Yeah, good evening.
Good evening.
Yeah, okay. I think we can start now. What do you think, Mr. Tete? Mr. Tete, are you there?
Yeah, sure. Yeah, hello.
Yeah, I think we can start now.
Yeah, sure. Yeah, sure. Yeah, we can start now.
Okay. Okay, so good evening, everyone, and welcome once again to Legacy FX. I think this is our first training section. So this presentation has already gone out. So you guys have already read some few things about it. I'm not going to be reading from the presentation. No, I'm just going to explain the things, like how things are supposed to be. Giving a presentation without talking is a little bit difficult for some people to assimilate. So without much ado, we will begin in the name of the Father, Son, and Holy Spirit. And I'm going to mute everyone now. I'm going to mute everyone, and I'll be the only one talking. Now you guys will hear me because there is some noises on the background. So I'm going to mute everyone, and I'm going to do the talking. If you want to ask a question or something, you can go to the chat section to type question, or you can raise your hand. If on your app you could see raise hand there on the app, you can try to raise your hand. But as time goes on, I'll be unmuting, and then I'll be asking whether there is any questions or not. I hope everyone is okay with that, and we can start.
Yeah.
Yeah, sure.
Okay.
Yeah.
Thank you. So I'll mute everyone. Yeah. Hello. So we begin now. So as per our syllabus, if you could remember what we gave out on the syllabus, we had some few things that we need to be discussing through this journey of trading till the 3 months is due, or 3 to 4 months is due. Some people will be in 4 months, some is in 3 months. And then we will hand over your $1,000 account to you so that you could trade on your own. So we are trying to put up something so that even the person who knows nothing about trading will know what to do when this money or account is handed over to them. First and foremost, you guys need to put it in mind, or get it in mind, put it at the back of your head, that this $200 we are trying to move to $1,000 for you is not for consumption. And I repeat, it's not for consumption, because Legacy FX now, we are risking all we can to help you guys now, because this is our start. We are starting, we want to grow together with you guys. So this money that we're going to give out after the 3 months is not for consumption. So this will help you. Trust me, if you like, you can try to consume your own money, bro. But it's just like you are chopping your eggs, all your eggs in one day. If your hen dies, who is going to lay the eggs, the remaining of the eggs for you? So best thing to do after you receive that money and the trainings that you're going to get from now, trade with the signals that will be given to you. And I advise everyone to keenly follow the signals that will be given out by Legacy FX, and not to use any, I'm not saying don't use any other signal at all, but yeah, it's advisable you don't use any other signal at all, because we know we are giving you good signal. We know our signals are going to get you this amount of money daily, or we know how many pips you're going to get. So we are expecting returns, you making a lot of returns, and then you paying your authorship. So it's always advisable that you go keenly with what we are trying to put up here until further notice or advice otherwise. I will mute everyone now, and if you have any question before I continue, we do so. So is there any question? I will mute everyone. Any question? Hello? Hello?
Hi.
Yeah, is there any question?
No, please, not from my end.
Okay. Mr. Nathaniel, any question? Mr. Nat, any question?
Hello.
Mr. Nat, any question?
No, please.
Okay. Okay, so I'll begin everything. I'll mute everyone again, and then we continue. So now we're talking about Forex. I'm going to give you a general understanding of Forex trading, what Forex actually is. The first module, we have the general overview of Forex, some trading terminologies, and then we'll be talking about the types and analysis and volatility indices. So without further ado, let's start. Forex itself basically means foreign exchange, and if I should put it very simple in simple terms, it's just like you going to the black market. You having some foreign currency, and you going to the black market to go change your money. It's a similar thing. That is all we mean by Forex, foreign exchange. You have dollar, you change to cedis, you have cedis, you change to naira, whatever you change, this is Forex. And that is how it goes. And in Forex, we have a lot of ways that we trade and a lot of things. Commodities also are there. We have the futures, we have extreme, like other things that are traded on the market. One thing you need to know is the Forex is the currency market. That's the currency market. The Forex currency market is like 24 hours kind of a thing, but runs from Mondays to Sunday to Fridays. It's not a whole week, all week something. It ends around 9 o'clock on Friday, and then begins around 10 to 11 o'clock on Sunday. So this is how the general overview of the Forex is like. So let's say I have money, I have some dollars now, and then I go to the black market to change some dollars. And when I went there, they told me, oh, $1 is 1 cedi. Let's assume $1 is 1 cedi. I was okay. I have $50. Can you change for me? They gave me 50 cedis. This is good. For me, it's good. One thing you need to know is this is the price that the Abochi or the black market man is selling to you. He's giving you your 1 cedi for your $1. But one thing you should know is when somebody else comes to buy your $1, he's not going to sell it to the person one cedi and he gives the person $1. No, he's going to sell it maybe 1 cedi, 20 pesos. I'll give you $1, so that he can make a little bit more from that. You see, so you see, he has the selling price and then the buying price. So when we get to the terminologies, this thing will let you understand where the ask, bid, and then the spread is coming in. You understand? So this is all about Forex. So that money, that 20 pesos he made on your $1 is his profit. And that is what we trade on the currency market. That is all we do on the currency market. You see, so this is a general overview of how the currency market. So just we are saying, like I was using US dollar and the Ghana cedis. It's a similar thing there. Hello? So it's a similar thing there with the USD and the Ghana cedis, same like any other currency. So these two currencies are actually fighting each other. Which one is stronger? Which one is affected by Corona? And then we see who's going to win the war. So that is the general overview of trading and on Forex trading. I should be more precise. This is a general overview of Forex trading. Any questions before I continue? I will mute everyone. Any question? Any question? Any question? Any question? Any question? Any question, or I should continue?
Continue.
Okay, okay.
Yeah, I think we are good.
Yeah, good. Okay. So I'll mute everyone again.
Please, the line was breaking, so I couldn't hear some parts.
Okay. Which part? Where did you miss?
Where you got to SMC, you were saying when you can change the currency at the black market.
Oh, okay. So what I was saying is, like, I was just giving a general overview of what Forex is, like for the foreign exchange. And I was using the currency market, for example, in the black market. So let's assume you have $1 and then you want to change your dollar to cedis. Okay. Okay. Because of the noise, I'm going to mute everyone again. And then after explaining, I will mute everyone. Is that okay? So like I'm saying, you went to the currency market to change some money and you went to change a dollar. You were lucky enough you had a dollar for one cedi for $1. So you change your $1 and then they give you one cedi, right? Good. Now the seller or the one who is selling bought your dollar for one cedi. But if another fellow is coming to buy that dollar from him, he's not going to sell it to them at one cedi. He's going to sell it to them maybe one cedi 20 pesos or something. So that 20 pesos there now becomes his profit. And that is all about Forex. That is what we do in Forex. You see, it's the same way maybe you bought it $1 for one cedi. If you yourself, you come back that I want to change my cedi back to dollar, you're not going to get that your cedi you sold at the same price. Reasons could factor. One, we have the spread, that is for the broker, or the broker being the black market man. And then maybe as at then there is change in what? There is a change in the exchange rate. So if there is change in exchange rate, which means that let's assume that when you got there, now $1 is no more one cedi, maybe $1 is one cedi 50 pesos. You see, it is going to affect you. You are going to lose some money here. You get what I mean? So when you are going to change your cedi back to the dollar, you are not going to get your $1 back as it was before. You're going to get some cents. You understand? So that is what I meant by the foreign exchange market. I was giving a general overview of how and what Forex actually is. So you see, there are a lot of things, a lot of factors that actually influences these things, you know. There are a lot of things, and it's two currencies fighting. You know what I mean? It's like let me take for example US and China fighting. So the strong one wins. Or let's say Great Kali and then Rey Mysterio they are fighting wrestling, you know. Usually we will say, oh, Great Kali is taken top, so he's going to win the game. But who knows? Maybe Rey Mysterio with his chemistry and his acrobatic skills is going to win the game. So it's two currencies which are actually fighting, and a lot of things comes into play when this is the case, because the country being strong means it has a stronger currency. You understand? Like the tag of war showing on your screen now. A stronger country means you have a very strong currency. And when you have a strong currency, then you can pull the other one. A lot of things come into play. We have factors such as the political, the economical, we have the social stuff, we have the technical stuff, and a whole lot of other things. You see, I always say that if you learn how to trade Forex and you learn it very, very well to understand what goes on in trading, it will be very, very difficult for you to go to work and you will be sleeping, especially government workers. Because if they actually understand what it entails, like the job that they are doing, what it is doing for the economy, and and not just the economy, but what it is doing for the country on the market, then they will know they need to work hard. Because if input is not matching output, the currency will be falling. Trust me. And when the currency is falling, your economy will be falling, and then it makes the currency fall or your money falls. You get what I'm talking about? If you understand a lot of things that comes into play for a currency to rise, because you hear people say, the city is falling, the NPP or NDC is not doing anything about it. Sometimes it's not them, it's our own attitude. And a lot of things play into this thing. When we get to the analysis aspect, we'll talk about this. But just for me to move on, I hope it's clear about the general view of what Forex trading is. If there is anything, I would like to unmute everyone, and then you tell me if you need any, if you have any question. So any question? Any question? Hello, guys. Any question?
No question. Go on, go on, go on.
Okay. So
Yeah, bro, on my side, I'm on side. I think it's cool.
okay. Okay. So I'll mute everyone again, then we'll continue. So I'm not going to talk about the majors. I'm not going to talk about the minors because they are very, very self-explanatory in the presentations that I gave you. And I didn't want to, you know, before you understand whatever we're about to do, especially with this team, this group of people, you really need to know about trading. And that is why we took it upon ourselves to take you through everything, and especially Forex trading. But we will dive more into the volatility indices because that is where we are going to take you guys to. But that will be later on. This is just for you to know. So we have the majors and the minors in the market, and from the presentations that I've given you, I think it's very self-explanatory. And if you don't understand anything, maybe when it's the question time, you can try to ask anything about it. But for that, it's usually, I think it's very self-explanatory. So I'll move on to the next slide. Now it's about what we do on the market. So like I'm saying, we're buying and selling, just like the example I gave out, you know, about the black market. That is all we do on the market, on the Forex market. You see, some people are buying, some people are selling. So there is a question that, when do you buy? When do you sell? You buy, especially in Forex, you buy when prices are low. That is when we buy. We buy to keep them. And then when prices get high, we sell it out. You see? So it's like now. Let me give you this simple, very, very simple explanation about what we do on the Forex market, and then we move on. So like I was using before, you were going on a vacation. Let's say you are now a billionaire through Forex trading, Legacy FX. And then you decided to travel out there with your private jet and other stuff, you know, go to the US to chill out. You took along maybe about 50,000 US dollars there. But based on, let's say you went to US with $50,000, based on whatever you were spending there, using your card, and you have, you know, you have a lot of business partners and taking care of everything, you ended up coming back home with your same $50,000 without using it. You understand? So first of all, maybe when you were, let's take it like this, when you were leaving, you changed 50,000 Ghana cedis to dollars, and it was one cedi to one US dollar. So you had $50,000 with you. I hope it's clear. When you were going, you changed your cedis to dollars, and you had 50,000. I mean, 1:1. So you had 50,000 US dollars. After your vacation, after your chilling and everything, when you came down here, you found out that one Ghana cedis is now equal to 50 cents. Do you understand where I'm coming from? You find out that one Ghana cedis is equal to 50 cents. No, sorry. 50 cents is equal to one Ghana cedis, okay? You find out that 50 cents is equal to one Ghana cedis. Oh, that is interesting, isn't it? Good. So you come back with your $50,000. You want to change back to your cedis because you can't spend dollars in Ghana. If you are changing back your $50,000 to your cedis, you're not going to get back your 50,000 cedis, but you're going to get $100,000. 100,000 cedis, sorry, 100,000 cedis. This is because there is a change in exchange rates. You understand? You have $50,000, and half of that $50,000 can get you 50,000 cedis because 50 cents is equal to one Ghana cedis. Do you understand? So in this case, you can buy more with the 50,000 you change. So it's going to be times 2 of what you lost. And then now You've made a profit by doing nothing, just going there, spending your money and coming, and then you made profit because you kept something in your pocket. You didn't spend it or something. That is all we do in the forex trading, like forex trading. We buy currencies and we sell them. We buy them when they are low and we sell them when they are high. That is the basic thing that we do in forex trading. And if you look in the PDF and the presentations that we give you and the PDF that we give you, we have some examples there using the agriculture aspect. You know, I like to use the banana a lot. Even during university time, I was using banana for my project. Okay, that was just a joke. So let's assume we are in a banana season. You know, a lot of bananas are in, like a lot of bananas there, a lot. So what happens when there is a lot in the system? They can perish. You understand? They can perish. So because the farmers do not want the foods to perish without like selling them out, they are going to sell these things at a lower price. You understand? They are going to sell these things at a very low price. So when they sell this thing at low price, when there is excess, like there is a lot in the system, what will some of the market women do? Some of the market women, what would they do? Go there, buy the banana, and then maybe using some 1 or 2 natural ways to keep it unripe. See, I can give you an example. I am actually by profession, I'm a sailor. And with my last contract, we're carrying fruits from Africa here to Europe. Do you know what we're doing? After we get the fruits inside the container, we're pumping nitrogen gas into the container, I mean the reefer container, under controlled temperature. So it keeps these fruits unripe. The thing is, because we are able to preserve it, it will last long. And when are they going to release it? They are going to release it when there is scarcity in the system, which means there is a higher demand for banana now. So maybe the bananas he bought for 50 pesos per container or 1 cedi per container, a whole container, because he was able to preserve it, keep it within that time. Till now, there is no more banana. A lot of people need banana in the system, especially to feed their monkeys. What do? There will be a higher demand for it. They will release their banana. But in this case, they have the upper hand. So if they tell you 1 container is 100,000, you cannot say much, because your monkeys will die, or even yourself. You see where I'm coming from? So this brings a demand and supply here. So when there is a higher demand for the thing, the demand of it drives the price. Like the demand pulls the price along. That is how it is. Because when we get somewhere in Forex, you understand that it's not that everybody, because everybody is buying, so I need to buy. Sometimes when it gets to a point, you will understand. Yes, maybe there is a higher demand for the buy or something, or there's a but sometimes you need to be careful, like I'm saying. It matches with price. When there is a higher demand, the demands come before price moves towards the demand. So when you are doing your analysis, you need to be extremely careful. This is for future use. You need to be extremely careful. Don't go buy when it is overbought. And don't go sell when it is oversold. Because you might get to a point that you'll be buying, you'll be selling, and then the price at which you are buying or the price at which you are selling doesn't make sense. It's not matching the supply. You get it? So when there is a higher demand for it, the demand pulls the price. So you need to look into the system. Oh, there is a higher demand for banana. Okay, like recently, we saw a higher demand for hand sanitizers. Some people still kept their hand sanitizer, waiting. You see, they were supposed to sell, they didn't sell. Some people increased their own within that short period of time. Some people were like, let me still keep mine a little bit until Casapreco and Co started doing hand sanitizers and then releasing it into the system. And now you can get a lot of locally manufactured sanitizers. Bringing the sanitizer product, even though the price is still high, but the supply is matching the demand. So that it is a stabilized price now. So anybody who claims I'm buying sanitizer now to keep for tomorrow to sell, trust me, Corona will be over and you will lose that money. because maybe what you are buying now for $50,000, for 50 Ghana cedis, will after some time will be sold for maybe 1 cedi, and then you've lost the money. So you need to know exactly when there is a higher demand, and then check the price compared to the demand, because the demand pulls the price along. You understand where I'm coming from? It's not that because there is high demand, there is high price. No. When there is high demand, price moves towards the demand, mean high. It moves, like it starts to move, it grows. That is it. Until the demand matches the supply, then what? It is going to pause at that place until the reversal happens again. So yeah, just like this video was about, I'm not going to let us watch the video. We'll just move into terminologies, but until then, let me just unmute everyone and ask some questions, if there is any question. Any question so far? Any question? Any question?
No, please. Hello.
Yeah, go ahead. Oh, please put your mic close to your mouth so we can hear you. We can't hear anything.
Hello.
Yeah, this is better.
I'm saying the volatility and then the forex. What's the difference?
Oh, okay. We will get there. I don't want us to rush to volatilities now. I just chipped it in because I wanted you to know that, yeah, we'll be. I think what you see. Even I gave you some the second presentation I gave out. It has a little explanation about the volatility, right? Even there is a video there. Yeah, but we are going to dive more into it later. But one thing you need to know is with the way we are trading volatility and then the way we trade forex. Okay, we are now in the terminology. Let's gradually get to there. Then you maybe you bring up the question again. Okay.
Okay.
Because the truth is one cannot trade volatility if you don't really have any idea about forex, especially the currency. That is the truth. So that is why we are also trying to bring it up from here. If not, we could just take you say, oh, this is volatility indices. Yeah, this is VIX 75. This is that. Put buy here, put sell here, and then that's how you're going to make it. But we just want you to catch everything gradual. So, because very soon we will get there, and then you remind me of this question. Okay. Okay. Any other question? Okay. Yeah, good evening. Go ahead.
Oh, sorry, not you. No question. Go on.
Okay. Okay, so let me continue with the terminology. Sorry. Okay. So now, like I was saying earlier on, the ask and the bid. What do we mean by ask and what do we mean by bid? You see, the ask is the what is the price that the broker is willing to sell. You see, now they've used another term here, broker, which is also here. So for the sake of this broker here, I would like to explain what broker is before we continue. If you look at, I don't know whether you are seeing my mouse. Can you guys see my mouse? Can you see my mouse, please?
Yeah.
Can you see my mouse?
Yeah, we can see.
Okay, thank you. So, you see, this is the prices that the broker is willing to sell the currency. What is a broker? Let me come in here. You see, I'm not going to bore you with plenty things about, especially the business part of it. I'm just going to give you a little simple illustration of who a broker is. Is a broker is actually, okay, I say I'm not going to go too much into those businesses. So broker is like, we were using the black market, for example, we're using the black market, right? So the black market, the man selling at the black market or the Abuchi man is like a broker. What do I mean by he's like a broker? He is there and he's selling. At the same time, he's buying. You need cedis. You have dollar. You come and change your cedis, your dollar to cedis. He will take it. He doesn't need the cedi. He doesn't need the dollar. But maybe Mr. Ewonam has dollars and wants to change to cedis. You go to him. He will take it for you. And then maybe Mr. Nat have dollars. Hey, you have cedis and want to change to dollars. You also take it from him. And here is the case, he's going to take it from Mr. L and I'm giving him a price. And then he's going to sell it to Mr. Nat, giving also another price. So I hope we understand what a broker is. So the broker is like the intermediary. You know, actually with the brokers, the thing itself doesn't really concern them. Their own is they are buying from you at this price, they're selling at this price. And the difference that comes in, we call it spread. You know, and that is their profit. We call it spread, and that is the profit. So in the Forex trading market, the brokers, they are between us, the retail traders, that is you and I, this small boys, and the big banks and other stuff. That is the basic understanding of who a broker is. We have several of them. As time goes on, when it comes to the account opening section, everything, we are going to advise you on which broker to choose and what to do and how to know good brokers and other things. And even in the PDF we gave out, we have some stated certified brokers there. You know, every individual and the way you trade, and then maybe what kind of broker that you are going to get. You see, let me give you an example. So because most of you guys are beginners, do not fall for some things. Example is this. We see the bid price, we see the ask price. We are saying that the difference is the what? Is the spread, and that is for the broker. You might see some brokers, not some, maybe most of them, almost all, even though they are certified, telling you they even have a zero spread trade, which means that if you buy it at 1, they are going to sell it at 1 to you, everything. Yes, it is true. But one thing you need to know is then you pay them commission. So it is almost the same thing. The only difference is with a spread, maybe with a spread based on the volume that you are trading, then the amount that they are going to have. But with the commissions, they have specified range. Maybe if you are trading from this amount to this amount, you are going to pay this amount of commission. If you are trading from this amount to this amount, you pay this amount of commission. Yeah. So don't be moved by, oh, it's a zero spread. So try, you can put a trade, zero spread, yes, but you at the right corner there you see commission. You'll be paying something. So always the broker is also in to make money. So that is the work of a broker also. So the ask price is the price they are willing to sell. The bid price is the price they are willing to buy from you. Okay, now let's move on to spread. We've spoken about spread, broker, the closing rate. You know, the closing rate is, let's assume you start a trade and the rate was 1.1, and then at the time you end the trade, it was 1.0. So that's the closing rate. The opening time was 1.1. That's the rate, and the closing is 1.0. That is actually the simplest way. I want us to go through the big parts of it, like leverage, You see, leveraging is like let me say I'm borrowing you some money. You understand? See, we are retailers. I mean, retail traders. We are retail traders, which means we don't have enough capital. Trust me, your $10 you are going to load, or your $1,000 or your $100 doesn't move market. No. You are a retailer. You follow market. You understand? And if you should go to the real, let's talk something about like the Wall Streets and co. You cannot trade with that amount of money, because the volume of cash that is being dispatched within this period, like this thing, is huge. But the leverage comes in, it's like the broker, when you put amount or you put a trade, the broker is able to lend you some amount of money to make it huge for you to enter the trade, something like that, so that you are also qualified for the trade. Which means that one thing you need to know about leveraging is, since if you take big leverage, you pay big interest. You understand? Take big leverage, you pay big interest. You take minimum interest. So leveraging your account, don't over leverage your account when you're creating account. It's very, 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 very dangerous. So let's read what is here. It's saying that our ability to hold an investment position for greater value than that of your equity. Exactly. So maybe you have $100 and then you put a volume of 0.1. Sometimes you see it's possible. You put a volume of 0.1. You know what it is to put a 0.1 trade in actual terms without leverage? That's huge amount of money. That's like I think $10,000 worth of trade per pip. I mean per pip, per one movement. You see, so if you have $100 account and then you leverage it 1:1,000, and then you are able to put a 0.1 or a 1.003, and you think you will make big money fast, bro. The thing is, yeah, you can make 10 million within 2 seconds. It's the same way you can lose that $100 in a microsecond, because even maybe the spreads will even kick you out of the game. And trust me, it is better to manage your accounts, to go at a loss and have something to trade back and get what you lose. Because if you don't do that and you over leverage your accounts, trust me, you'll be blowing. Maybe first today you put $100, you over leverage it, it goes off. Tomorrow you put another $100, you over leverage it, it goes off. Tomorrow you put another. Trust me, in 1 week time, if it is 5 days, $500 already. You get what I mean? So when we are trading, we need to take a lot of things. We are going to teach you how to manage risk and other things. So we're going to teach you how to properly leverage, take proper leverage when it's when you are trading. So when leveraging investment, you need only deposit a fraction of the current value. Yeah. That is just some English stuff. So basically, I hope everybody understands what leverage is, and I will move to the next stuff. Now we have the lot size. Good. Like I was talking about some volumes here. Like I was saying that when you put a 0.1 lot size, it's almost like 10,000 units of that currency, of the base currency. So if let's say if you are trading USD yen, USD yen, you are trading at 1.0, 0.1. Is $10,000, like of the base currency, that's the USD, and maybe you have only $10 or $100, always $1,000 only in your account. So the question is, how is it possible that you can make such trades? It's possible because the broker gave you that opportunity to leverage that much, and you took that leverage. You will see, sometimes you have a leverage of maybe 1:100, 1:200, and you cannot put a 1.00 trade on $100 account. And then sometimes the same $100 account, you have a 1:1,000 leverage, and then you can put that amount of trade. That is what we are talking about. You've taken a lot of loan, it will come out with a lot of interest. Remember, big loan, big spread, big and faster fast for your account to blow up. So that is about volume, about lot size also. So we usually use the lot size to manage our risk. If you know your lot size and then you know each pip that you are going to move, with lot size and the pip, you can calculate the value per pip. And if you can calculate the value per pip, then you know that maybe I want to raise maybe 2% of my account per trade. So if you are raising 2% of your account per trade, then you know that maybe $2 only. So if I want to trade 20 pips and lose just $2 on a 20 pips, what lot size do I need? Maybe you need a 0.001, a 0.01 lot size. Then you can put, or maybe you need a 0.2 or 0.02 or 0.0. then you use it to calculate. So the lot size is actually the volume, and if you read it very, very well, it says it all on lot size. But we'll go more deeper into it, and you will see it when we get to the charts and everything, and you know and feel the essence of managing your risk, and especially your lot sizes, because we are going to have a lot of demo trades with you guys before we hand over your money to you. So through that, if there is any mistakes that you need to do, that is where we will expect you to do all the mistakes so that it can be corrected. Yeah. So now let's go to take profit and stop loss. So when you say take profit and stop loss, you see, you cannot sit by a computer like 24/7. Sometimes you do your analysis. The analysis is, you have your own strategy. You've done the analysis. The analysis is strong. So you know dollar will move to this point, or this one, there will be a higher demand for it. So the price will draw to this point, or there is a lower demand, so the price will drop to this point. So because you cannot just be sitting at the computer monitoring it, you create or you put a value at which when your currency reaches the, your trade reaches there, that's what it closes automatically. And then you take the desired profit. It's the same way, maybe there will be a loss. And so you are saying that, oh, if this strategy is not working, if it's reached this number of pips, take my loss or stop my loss. So if you are reaching to maybe negative 20, negative 10, negative what, automatically, since you've put the value there, it closes the trade for you. So it's like you executing a trade and then you setting something like a take profit and a stop loss. Trust me, even if you're in the village and your internet is not good, so far as you have your take profit and your stop loss, your trade will stop when it hits any one of those. That is how, or that is what we call the stop loss and then the take profit. So now, like we were saying before, the currencies in the Forex market, they usually run in pairs. As you can see, in pairs, GBP USD or Euro USD, everything. The first one is the base currency, and then the second currency is the quote currency. You understand? So let's take this for example. So which means that you will need 1.32 USD to buy 1 euro. You understand? You understand? Is it the currency you are buying when you trade in the forex? So you are buying this. So either you are buying this or you are selling this, the base currency. When you click on the buy, it means you are buying the euro. When you click on the sell, it means you are trying to do the opposite. So this is it. When you get this thing, and this is the rate, which means that you will need this amount in USD to purchase one of this. So the quote currency buys the what? The base currency. So let's say we click on the buy here. When we click on the buy, the quote currency was 1.32105. And then when we stop the trade, it was what? 1.32, let's say 20. Let's say 10 pips up, 20. So in this case, which means that you used a lower amount of money, are you listening? To buy 1 euro, and at the end of it all, you are selling that same 1 euro at a higher price. Do you understand where I'm coming from? I will mute everyone to know whether I'm making sense. Do you all understand?
Yes, please.
Okay. Anyone with any question, or I should continue?
Continue, my battery is dying.
Okay. Okay, so like I'm saying,
It's a command, pal.
don't mind that boy. So like I'm saying, yeah, so let me just skip here. I think it's clear to everyone here about the base currencies and all stuff. So PEEP, like I was saying earlier, you see, when in Ghana or everywhere they will usually use 2 decimal points. So what is that current exchange rate? Oh, 5.77, oh, 5.78, 5.660, 5.8, 5.9. We always use 2 decimal place, 2 decimal place. But actually in the business market, it is 4 decimal. It is to 4 decimal places. And this, the fourth, it changes frequently. And the change is what we usually trade. That is how we are trading. That is how we are trading. That is what we are trading on. And when it moves from 1 to 2, it's 1 pip. When it moves from 1 to 0, it's 1 pip. When there is 1 unit change, I mean to the 4th decimal point, that is a pip. That is the basic principle of what a pip is. And then we have the piplet. We have the piplet because you see, most of the brokers like to quote to 5 decimal places. This is the piplet, or we call it piplet or pipet or point. I usually call it point. Call it pipet or point. You see, 10 of these will make 1 of the pip. Usually we don't pay much attention to that. We pay much attention to the pip itself. To the pip itself. So that is for pip also. That is what a pip is. I'd like to go back to show something. Yeah, I think, yeah, that is it. So continue. That is what a pip is. But one thing we need to understand is not all the currencies that are quoted in like 4 decimal points, or 4 decimal places. Some of them the quotation is, some of them the quotation is to 2 decimal points, and usually it is the yen pairs, the Japanese yen pairs. It is to 2 decimal point 4. So when there's one change in the second one, like this one, then is 1 pip, and the brokers will be quoting to 3 because of the pipet or the points. I hope it's understandable. Let me just go to the previous show something. Okay, yeah, I can use this for example. Now let's look at this here. You see it's 0.97378. This 7 is the 4th there. This is a pipet, this is a pip, or this is a point, and this is a pip. So when this 7 changes to 8, it's 1 pip. When it changes to 6, it's 1 pip. You see, now let's take a yen pair. You see, this is a yen pair, euro yen, 0.202. So this 2 here, changing this 2 here is a pip, and changing this is a pip or a point. That is a basic understanding of this. And we'll continue also. Oh, sorry. Yeah. Okay, so now yes, we are talking about bullish market. And then we'll talk about the bearish markets, and then the trending market, and then okay. So when we say bullish market, it means there's an upward trend. I mean, buyers are in, prices moving up. But we say a bearish market, prices going down. You understand? There's a lot of sells, a lot of shorts. Now when we say trending, you see, we have markets moves zigzag. You understand? And when it moves zigzag, it moves along the trend. Could be an upward trend, which means it is a what? A bullish market or a bullish trend, or a downward trend, which is a bearish market or bearish trend. You understand? When we move to the next slide, we will see more of that. Now we have the ranging or consolidating market. So you could see it gets to a point that market will be fluctuating. Let's say Ghana, for example. For some time now, we've been seeing market fluctuating from 5.4 to 5.7. For some time now, at least 8 months from now, 8 months before now, price have been fluctuating from 5.4 to 5.8, 5.7. You see, so in this case, you could say that the market is consolidating within this point. So let's say let's take just a minute. I'll try to get a board and then we will see. Okay. So let's say this is 5.8 and then this is 5.7, 5.4, sorry. So maybe here is September last year and then the rest. So maybe September last year it was here. Then maybe October price goes here. November it comes here. December it goes there. You see, this is a consolidating market or a sideways market. It goes up and down. That doesn't mean you cannot trade here. You can trade here because if market is consolidating for a while, when it gets here, it's at a low. You can buy. When it gets here, you close your trade, and you can sell here. When it gets here, you close your trade, and you can buy. That is if it's consolidating. But please, don't keep. You see, I always say when you are trading, you always have to watch the market very carefully before you conclude on some things. Maybe it's a trending market, or is it this, that, is it that. Yes, it's a trending market or whatever, but you need to be extremely careful when you are trading, because when you go and you are trading, maybe the market is consolidating. That doesn't mean it's consolidating for the rest of the time. Consolidating for a reason. You understand? A support maybe which is very strong, or a resistance which is very strong is holding this market. That doesn't mean that the market cannot break the support or resistance. I don't want to move more into support and resistance because we will treat it as a whole topic on its own. But like I was showing you before, this 5.7 and 5.4 has been holding for some time now because the market makers are keeping price within this range. So they have a strong support there and a strong resistance within this point. I could even come that with these corona issues, it could make the dollar at the city fall or something, and then phew, we are going way down. Then tomorrow you wake up and then maybe $1 is 7.0. Imagine if you are making you are at the edge of making $1,000 a day, and then $1 is like 8 CD, 8,000 a day. There's no need to work. Sorry, let's continue. So that is ranging and sideways market. Now, when we talk about the bulls are the buyers or the buy guys, and then the bears are the sellers in the market. So we say the bulls are in the market, which is there are more buyers in the market. The more buyers in the market, which means there's going to be scarce of the currency. But we are buying, it will finish. You understand? So when it's getting finished, what happens? Prices keep moving up because when it's finishing, there will be higher demand for it. That's why I'm telling you that don't say that there's a lot of buyers in the market, so let me go. No, maybe by the time you are going, the buyers already in the market have pulled the price to a higher point. So always take your time to make your analysis. It's very, 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 very important. And then the sellers, the bears is the sellers. Then we have the retracement and the pullback. Retracement and pullback, I'll explain it in a very simple way for everybody to understand. I'll use the board. So first of all, one thing we need to know is, like I was showing you like this in the trade, Forex don't move that way. It doesn't move that straight. You see, just here, we could have a lot of movement. Just one of these, we could have maybe this, that, creating just one of these. And in the same way here, we would have the same thing. You see, now when we're talking about trending, when we look at this, it's an upward trend. You see, it's an upward trend. You see, or upward channel because it's moving like this. So it is channeling along this upward trend. You get what I mean? Yes. So now, since it's an upward trend, all buys goes with the trade, and then what comes, you see that little cells you are seeing, or that downward thing here, is what we call the pullback or retracement. You understand? That thing here is what we call the pullback or retracement, because it is not going to change price, but rather it brings price to a point and it gives it momentum to move up, and then it retraces again or pulls back, and then goes, pulls back, goes, pulls back, goes. That is how price moves. That is price action. We're going to treat price action more into details. But if you're talking about pullbacks, these are the pullbacks. And trust me, these pullbacks are very, 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 very strong. Let me give you a reason why I'm telling you they are very strong. You see this? Maybe you entered a buy here, right? At this point, you entered a buy. Trust me, it is still a bullish market, which means you're supposed to make money from this. But you see, when you place the buy here, it didn't continue to go up. It what? It pulled back. You see, before it came up. This pullback here, if you don't trade careful and you don't manage your risk, can clear your account. And when this thing clears your account, you see that some people will say, Charlie, my money finished. No, they start to go my way. Yeah, it's because of this pullback. That is why when you are trading, we'll teach you how to calculate your risk per reward ratio. If you are risking $20, maybe you want to make $40. And if you are risking $20, how many number of pips you are going to use to make your $20? We're going to calculate everything and going to show you everything. So that when we give you signals, you trade well and make good profit so that we can also get our auto ship and we all live a very good, comfortable life. We want to grow with you, trust me. Legacy FX is one of a kind. So this is what we call pullback. And this is why it's very important to know all these things. You see some people will say, Charlie, the guy gave me some sniper entry. Yeah, what does it mean by sniper entry? Maybe the signal that was giving you, you took the signal here. Just imagine, as soon as you enter the trade, straight to positive. So the only negative you might felt was the spread. You see, which will be less, and then straight you hit into positive. And imagine you go all the way here before you pull back a little bit. So even if you pull back to this point and you close your account, you've made this profit from this movement here to here. You see, so that is how trading is, and that is how we all need to understand trading very well before we give you your $1,000 account. So now let's continue. Yes, exactly what I was saying. Now we see here, now this is a ranging or consolidating market. It moved, price was moving within this point. You could see sideways. This is a bearish, this is a bullish, sorry. This is a bullish, bearish. You see the pullback. Because this is a bearish trend coming down. If you sell here, you make profit to here. You lose a little bit of the profit, but you are not out of the game. You can still come back. You can still come back. But imagine you entered the trade here, sell here, and then it went this way and cleared your account. Then you see it coming back. Then what happens? The account is blown. So these are what we call the pullbacks. You see, we have the trend or the moving, the market, how the market is going, and then we have the pullbacks, which moves opposite to the trending market, but it is just for a period, just for a moment, then it goes back with the trend. So this is how, you see, I was telling people that in every, you see, look at, let's just take just one, just look at this one down. You see, you see here one down like this, but it's not just one down. Here is a bearish candle. Here is a bullish candle. Here is a bearish candle. Here is a bullish candle. Here is a bearish, bullish, bearish. Trust me, if you are selling, let's assume you sell here. You enter your trade on this bearish candle, sell. This bearish candle closed here, right? It started there and it's closed here. Here there was a gap, a little gap, that's why it moved. This one is supposed to be here, but anyway, no problem. What I'm saying is, if you enter the market, even one candle can be enough pullback, depending on the time frame you are using, to blow you out of the market. So there it also brings you to time frame or analysis, which means if you need to have a time frame that you are using to analyze the market itself, so that your risk is based on that time frame and based on what you are ready to lose and the kind of pullback you are expecting. Example, if you are buying here and it comes here, you are selling here and it comes all the way here and it starts to pull back, and then this pullback ends and then there is more sell to this point. One thing I will do is I'm going to move my stop loss. This was where the trade was. I'm going to move my stop loss to where I started the trade so that in case my stop loss should hit, I don't lose money. We call it break even. We call it break even. So the stop loss hits exactly, it came, maybe it reversed whilst you were sleeping or something. It will hit exactly where you put your trade because that is where you drop your stop loss to. You see, or in other words, you sold here, it came down here, it pulled back, it came down here. You can decide also, that is how some traders do, to pull your stop loss down here to this point. Because usually, as soon as the pullback should be equal to or above the previous resistance A, this is going to be a resistance point, which means it's breaking it. When it is breaking it, there is probably a reversal or change in trend. So if you put your stop loss here and it's breaking it, you've made this profit at least. You understand? It's like I'm even going more than I'm supposed to because we are giving the limit of, the basis of trading. So this is how the market is like, and this is how things are like. Thank you very much. I will meet everyone for any question and then we'll continue. Any question? Any question?
No, not for
now.
Not for now. Okay. So we'll move to the second slide and then we see what's up there also. Okay, so the second slide here. So here we are going to talk about the analysis, the type of analysis. And then we are going to talk about volatility. The basic aspect of volatility is the basic, okay? So the type of analysis, we have three types of analysis. The question is, why do you even need to analyze the market? You see, I'm going to mute everyone now. I'm going to mute everyone and continue.
Okay.
So why do we need to even analyze the market? Guys, you saw what I was just showing up now, whereby pullbacks or retracement can just kick you out of the game. And there are reasons why you need to do your analysis. Example, now I am in Ghana here. I don't know what is going on in the United States. I don't know what is going on there. I need to watch the news. I need to watch all these things are types of analysis. You need to know how the country is doing, and you know how you are trading against or with what them. That is how it's supposed to be. So before you enter trades, you need to do your analysis and know how everything is going before you can enter any trade. So like the banana seller and the tomato sellers will do. They will decide, today now we have plenty tomatoes and let me buy plenty and make it to tomato paste. Yeah, they've analyzed the market, they see that there's a lot of it in the system. And very soon, because of the way they are being kept, nobody is preserving. It might all get rotten to perish and the people will need it. So let me just convert it all to tomato paste. That is analysis he has made. Then he will what? Later sell it. So there is a need to make analysis, and we have three. Usually, a lot of traders will tell you two types. A lot of traders usually use the two types, but I always advise the three. I always advise the three types of analysis. The reason being adding the sentimental analysis, which a lot of people omit. But I always advise for the sentimental analysis because of the supply and demand I was talking about now. You know, that is where usually this sentiment plays a bigger role. Support and demand, supply and demand, sorry. That is where this sentiment plays a major role. So now the technical analysis, we have the fundamental analysis and the sentiment analysis. So the technical analysis, I'm not going to bore you with all these things. Oh, first with the fundamental analysis. Fundamental analysis, this is very interesting. If you can remember, when NDC was in power, you see, when NDC was in power, our current vice president made a statement. He said that when the fundamentals are weak, the exchange rate will expose you. He was talking to NDC because that time we had a very the city was falling, if you could remember. It was falling huge, and they have to stop some amount of money you can withdraw and all the plenty things. And then he made a statement that when the fundamentals are weak, the exchange rate will expose you. And then after he came to power, when Baumia and Co were in power, and the dollar was the city was falling, NDC made a statement that since you are saying when the fundamentals are weak, the exchange rate will expose you. Since the exchange rate is now high, which means that since the fundamentals are weak, which means that the exchange rate will also fall. And Baumia was telling them that no, the fact that the fundamentals are weak, the exchange rate will expose. It doesn't mean that when the exchange rate is weak, it's from the fundamentals. Now I explain into details. You see, the fundamental analysis, it deals with the country's economy, a lot about it. The interest rates, the unemployment rate, the GDP, and all those things that happens in the country. Like ECG giving doomsday, and they expect Ghana city to go up. Really? There is no productivity. You see, somebody going there to sleep at work and say, I am Juma. There is no productivity. These are the fundamentals. These are the things that move the market, like the fundamentals I'm talking about. They move the market, yes. Because the fundamentals will let investors come into the country or to push the investors out of the country. Let me give you an example. If right now Ghana have a higher interest rate, foreign investors will come in because they know that they will get bigger interest when they do business here. That's what we are talking about. So all these basic things that we do, our even attitude towards work, plays a part in the fundamental analysis. And usually we get to know of this fundamental analysis through trading uses. We are going to show you how you're going to get a lot of trading uses. But to repeat again, it's not going to be so much of a focus because we will be moving you more into the volatility indices in the next few times. So that is for the fundamental analysis. When you read this, you get more. If you've read it, you know more about it. Now, the technical analysis. The technical analysis is basically what I was trying to do earlier, trying to teach you the movement of the currency. I mean, the price actions, moving from one point to the another, we move in a zigzag direction. We have the pullbacks, we have the that, we have the this. And then, all these things, we use a lot of analysis, a lot of indicators, a lot of things to determine or to make our technical analysis. Some include Fibonacci sequence, Bollinger Bands. We have the support and resistance lines. We have a whole lot of things. The moving averages and a whole lot of other things. We combine all these things so that we get the graphical, the chart in front of us. We get a graphical thing of how the price is actually behaving and how it's going. Let me give you an example. You see, we believe that prices, we believe that prices repeat itself. Like, I mean, history repeats itself. Let me use that word. History repeats itself. So since we have, let me use this chart for example. Look at the history. This is what, if we are trading now, this is where we'll be trading. This is where we'll be trading. We are trading now because this is where price is, which means we don't know how it will go. But we have to make analysis and determine how is it going to go. Is it going to go up or is it going to come down? Now let's look at history. History is telling us that price went all the way up here. It couldn't break this, it came down. It went there again, it couldn't break it, it came down. It tried breaking this, it's not working. You see, which means that this is a very strong resistance point. There's a lot of resistance here, so it's not breaking. And here, it was even able to push it all the way down. You see, if you look at something, even here, becomes a strong support because it was not even able to even break down from here. You see, it went all the way, came here, this point. It went up again, came down here, it went up again. But this time, it broke it here. When it broke it, it rotated, it came here. And then now, we are going to use, sorry, we are going to use the, oh, my internet is now unstable. Sorry, guys, sorry. Yeah, it's okay now. So we are going to use the history we are seeing here, to enter the trade. So now we saw that all the price came all the way here, which means we're expecting price to go all the way there to this point. That is what we do. Right? That's what we call technical analysis. These are the analysis we do using what? History. The price action, the previous actions of the price. Then we use it to trade. Then we use it to predict, there's a way to predict future prices. Using history to predict future prices, exactly. So that is what we do by saying technical analysis. So it's nothing so big. It's not a big deal. It's not a big deal. But guys, we are going to go more into technical analysis because when it comes to volatility indices, usually the technical analysis plays a lot roles in volatility. Now, let me tell you the reason why I would say it's good to know all three analysis, just using the technical and the fundamental. So guys, let's have a quick one here. So this is your chart. You found that price was moving this way, it came all the way here, came down here, went up there, came down here, and you're expecting it to get here, right? So maybe this was where, and then maybe it's here. Now let's say it has bounced. So now this is still strong because it's not broken, right? It's still strong, it's not broken. And you are here. See, don't just enter trades. I always say this. Don't just enter trades. Forex trading, you need to do a lot. So like this now, check your fundamentals. Now your technical is giving you a general overview that maybe now it's going to be an upward trend. Sorry, an upward trend like this. But that doesn't mean that because it's an upward trend, you should just put a buy. Because the reason being that maybe at this same moment you're about to enter trade, there is some fundamental thing going on, some news release, some interest rate, some NFP, or farm payroll from the US, something that is going to let either investors go more into the currency or withdraw their investments. You understand where I'm coming from? So maybe the currency was doing good by trying to climb, and then there is and you entered a buy. Without making your fundamental analysis, there was a release of news which pulled the trades down. Man, you are gone, you are finished. You understand where I'm coming from? So you will need to do your fundamental analysis also to know that, oh, for my technical, it is a bullish. From my analysis of the fundamental, oh, the US dollar is doing good, which means it's going to confirm more. You can try to go that. Or somebody will also say that from my analysis, oh, the dollar is not doing good, which means it will break, so I'll wait. Or you can try to be like me. I hate trading when there is news because I'll give you reasons why I don't trade when there is news. I don't trade when there is news, especially in Forex, not volatility, in Forex, because people will say we have expected value, and then after the news is released, we'll have the actual value. One thing we know is this expected value is never the same as the actual. It might try. This is what experts think it will be. That doesn't mean that is what it's going to be. You and I don't know. So what do people do? Some investors, what they do is when there is a major news which they know is very strong and they don't have much investment, they will start taking their money out, wait for the news to finish before they go back into it. That's what some people does. So sometimes you see that there will be a news, then it will sell big, and then the next candle it will be buying so big. You see, the news doesn't change the market. It is the reaction of the investors that change the market. Maybe because the news was about to come, everybody was scared. Everybody started taking out their investment. So it started selling huge. You see, they started taking their things out, so price keep falling. And then after the news, maybe the news, sometimes even the news is not even so good. It's just normal. But they just push their stuff back. And then it can even move it to the same path it left, or it can even go higher. So you see, the reactions of the investors or the people moves the market in fundamental. So that is what I believe. So when I'm doing my analysis and I see there is trade, especially NFP. I don't trade NFP. I don't trade NFP at all. I'll just cancel. I'll wait for the trades to, the non-farm payroll to finish or some other news to finish, and then I'll go. Unless news is that I have made my analysis and see that, oh, yeah, this is a strong buy, which is going to support my bullish this one. Yeah, I know how to do fundamental analysis too, but fundamentals usually, like I'm saying, the market is being moved usually by the reaction of the investors, and sometimes not even what exactly came out. So trading and analyzing the market can be a little bit dicey. You need to learn and know and have a style of trading. So that is why you need to know these two strategies. I'm talking about the fundamental analysis and then the technical analysis. Now I'm going to put also the sentiment inside, and then we know how we are going. The sentiment is like you just thinking, oh, from the look of things, like I'm talking now, like I'm saying now, oh, from analysis, it's going to be buy, so we have buy. So from analysis, there will be a lot of buyers in the market. So from analysis, there will be a lot of sellers in the market. So from analysis, there will be this in the market. So from analysis, there will be that. Everybody have their own sentiment, their own agenda, the way they think about the market. You see, everybody have their own way of thinking about the market. So your thought about the market is where we call the sentiment. And that I'm not going to go too deep into it, but if I should tell you something, the market makers usually play on the retailers on this analysis a lot. They use this analysis to play on retailers a lot. Because when they see that, oh, retailers are saying that price is going up, so now we are having a lot of buyers coming in. That is when they sell out. You understand where I'm coming? Because they have already bought, drop price to a point for you to think there is a lot of buyers in the system to enter, then they are out. As I'm saying that in Forex trading, you need to make your analysis and make it very, very well. So that is where the sentiment plays in. So in sentiment and sentimental trading, you can either trade with or against. It depends. When let me give you a simple thing to do. Because I know some of us already have some idea about trading. If you're using the sentiment analysis, this is what you should do. If you see that a lot of bulls are in the market, or the bulls are in the market, when the bulls are in the market, you need to check the price. You see, check the price from there, so you can check your technical analysis to see where price is as at that time when the bulls are in the market. because when the bulls are in the market and then price is low, which means that there will be scarcity. So you can also go in for a buy so that the scarcity or the higher demand will pull the price up. Then when it pulls the price up, you can close your trade there. But if you see a lot of bulls in the market, let's say the time you have seen that price is okay, so you are closing your trade, is a time where another person is also seeing that, oh, a lot of bulls are in the market. You might enter the market without checking price, and maybe price is already at the highest point. Everybody is now out of it. Then price will fall. So you see, you can either trade with or against when it comes to sentiment. So you can trade with or you can trade against. So somebody will say, well, a lot of bulls are in the market. Oh, I'm not going to trade now. Let me check my technical analysis. I check my technical analysis. Price is low. Price is low. Okay, a lot of bulls are in the market. I'll wait. When I see price at high point, this point, high point, and still a lot of bulls are in the market, I'll start selling. Some people can do that because that is basically what these major market makers do. I mean, the banks and the country institutions, big guys, this is what they do. For us, we are just following them because your $100 or $1,000 account cannot move the market. So you need to play right, because one thing is they can also not move the market without following rules. And they can move the market only by what they input in the market. You know, the market can never be manipulated. It's an international thing. So guys, sentiment is very, very important. I know somebody will ask, how do you get to get your sentimental analysis and all that? So I'm going to share one way I do get that. I'm going to share one way I do get that. Sorry, just a minute. Okay, let me share the whole screen. Okay, so there is this website that I check always. Okay. Good. So you guys can see now what I'm showing. So you see, this is IG client sentiment report. This thing is giving you, it gives the general idea of how people think the market is going. You see, like this, for example, let me take USD. It has a percentage of buy and percentage of sell. When you come down here, you can see it more. ODN is a mixed feeling because you have 45% on a net long and then 54% on the net short. Which means 45% are thinking the market is bullish, and then 54% are thinking the market is this. This is how the sentiment works. This is how I get to do my sentimental analysis, to get to know how traders are thinking in the market. You see, I was giving you guys some example. I'll try to explain it a little bit here. Look at this. You see this blue line, when it's red, it means it is short, which is sell. When it is blue, it means it is buys. Now look at this. You saw that a lot of buyers were getting into the market here because buy percentage was increasing. You could see the percentage of buy was increasing. But start to look at something. When buy was increasing, price start to fall. Are you seeing it? Price is falling. The question is, a lot of buyers are getting into the trade late. A lot of buyers are getting into the trade late now. So now the market makers are now withdrawing their stuff, making the price fall. You see, and then see when you're like, oh, so it was a fake sell, it was a fake buy. So you see, the buyers start to reduce, and you see when there was a little bit increase in sellers, there was a little bit increase in the buy or a bullish sell. So when you are doing sentimental analysis or you are doing your analysis, it's always good to put all three in consideration. So to wrap it all up, like I was saying earlier on, to wrap it all up, your fundamental analysis to know whether there is some news or something going on as at that moment, how good the currency is doing as at that time, and then you do your technical analysis to see what is going on, how price is going to react based on history, and then your sentiment to see whether a lot of people are going to buy or a lot of people are going to sell. Combining all these things, you can make a good strategy for yourself and a very good trading journey. Thank you very much on this. So I'll ask for questions and then we continue from there. Any question? Hello, any question?
Wait, too. Yeah, hello.
Yeah, go ahead. Casey, your network is bad. I can't hear you.
Continue from there.
Hello, Mr. Casey, your network is very bad. Can you hear me? Hello? Hello, Casey.
Okay, I'm typing. Let me just type.
No, just say it. You can talk. We can hear you talking now. So feel free and say, ask a question.
I'm like, it's been 2 hours now. Hello?
Yeah.
It's been 2 hours now. They're really saturated. Can you just run up at least? Okay.
Okay. So I think we can end here if everybody agrees with what I'm saying. So that because with the volatility in this, I would like us to go more into it, so that later on we can continue with the training. Is it okay with everyone?
Just agree.
Hello.
Hi. It's okay with me.
Yeah, okay. Mr. Tete, are you there?
Yeah, hello, boss. I'm here.
So what do you think? We'll end for today and then later on we will continue.
Oh, okay. Oh, okay. I think what we've got to, we can end for today. Then
Yeah,
of
maybe we
course.
schedule another meeting.
Okay. Okay. Mr. Steven, are you okay with it? Steven John, Charlie left the phone somewhere.
See you. Sleeping off.
Okay, guys.
I'm okay with it.
Okay, so on this note, we'll call it a day and then continue later. Mr. Nathaniel, I hope it's okay.
Yes, please.
Okay. So thank you very much and then have a good evening.